So as an investor, those are the two ways that you would look to benefit from your investment. Now, the question is, when you are beginning to invest, so you've opened the account and now you're looking to begin to invest, you would ask yourself, most would ask themselves, well, which companies should I invest in? Or how much should I invest? And what costs would I incur? So basically, when you are looking to invest, you would firstly need to understand the nature of the market. The market is purely competitive, and therefore buying shares is a volatile investment. Therefore, there are certain strategies that we advise to adopt in order to minimize your risk or diversify your risk. So when you are coming to the stock market to buy shares, we advise you to buy at least in 3 companies or even 4 companies. That is the first thing. And when you are investing with Stockbroker Zambia, the minimum investment is 500 kwacha. So say, for example, if you wish to buy in 3 companies, you would, in essence, be spending 3 times 500, which is 1,500 kwacha for your initial investment. Our broker costs are quite minimal, and they come to 1.5%, which is basically 1% the broker fee. 0.5% is broken down into 0.375%, which is the commission that goes to the stock exchange, and 0.125% is the commission that goes to the SEC. So say in an instance, if you are investing on the stock market and you've decided to buy in 3 companies at 500 kwacha each, your total investment being 1,500, essentially you would be paying roughly about 22 kwacha about as a commission, so 1.5% of 1,500. So now that you have committed to buying stocks, you would ask which companies are the best for me to invest in. So there's certain factors that you would look at and that the broker would advise you when investing in stocks. The first one would be, what are your objectives? Are you a speculative investor? Are you an investor who has come to invest on the stock exchange merely for experimental purposes to see how it works and functions? Or are you in it for the long haul, which is how the market works best? It's a long-term investment, and if you are going to realize the return on your investment, long-term is always best. So when advising you to buy shares, we would look at a couple of things. One of them would be the financial foundation or the fundamental financials of the companies that we would consider. So we would look at having companies that have a strong balance sheet, a strong historic balance sheet as well. They are liquid, their cash flow is pretty good. And we'd also look at their profit track record and their revenue track record, because the whole idea is that as a shareholder, you do want part of the profit. And so your interest would be in companies that have demonstrated strong financial performance, and or in an instance, say for example, where a company may be in a current debt position but has potential for that profit margin, for your sake, we could possibly consider such companies. So we would, in essence, look at the financial performance of the companies, and also as an investor, you have preview to that information through what we call an annual report. Listed entities, listed companies are by the Securities Act obligated to publish their financials via their annual report. And they're also obligated to publish their half-year results, so that you as a shareholder, as investor, have preview into the performance of that company. So we'd also look at things like the liquidity of the stock on the stock market. If you buy into the company, how likely are you to exit at a time you may need to? So we would look at the trading history of that stock and see the liquidity of it. Secondly, we would also look at the dividend history of that company, and also the likelihood, based on the history and based on the financial performance of the company, paying dividends in the in the future for you to benefit from. So having said that, we would not only look at those factors, we also need to look at the industries in which the companies fall under, because the economic climates may shift, and there's no guarantee that they would always be sunny. There are rainy seasons. And so when advising you to invest in stocks, we also try to consider which companies may have a stronger chance of survival come rain, come sunshine. Right. So I would, for example, I would give you an example maybe of a company called African Explosives. We would recommend African Explosives as a buy based on, one, their financial fundamentals. Secondly, their dividend record is pretty good. And also the stock is a US earnings stock. And so in the instance, especially now where you see the kwacha weakening against the US dollar, African Explosives being a US earnings stock would benefit from that. There are other companies to consider as well. But before we get into that, maybe we can discuss which companies and which industries are listed on the stock exchange, just to get a preview. So basically, there are a number of companies that are listed on the stock exchange. There are 22, and they do fall under various industries. We have stocks in the mining sector. So we have ZCCMIH, we have African Explosives, we have stocks in the banking sector. So we have stocks such as Standard Chartered, Zanaco, Investrust Bank, Cadmont Bank. We also have stocks in the agricultural sector, such as British American Tobacco, Zambia Sugar, Zambeef, and we do have stocks as well in the financial sector, being the insurance, that is Prima Reinsurance and Madison Financial Group of Services as well. Right, so basically that is what I would say, is that if you are looking to invest on the stock exchange, you first and foremost need to contact your broker. You are free to come to contact Stockbrokers Zambia. Details will be provided in a moment. So you are free to contact Stockbrokers Zambia or any broker on the LUSE to open your brokerage account. You would require to submit your KYC documents, as earlier stated, as well as complete the account opening form. After which you would then select which companies will be of interest to you based on your objectives and also how long you wish to be in the market. Once you have your objectives outlined, you would be able to select with your broker the companies of choice. At Stockbrokers Zambia, the minimum investment is 500 kwacha, so you would then send funds to your broker. You can either do so via bank transfer, via check, via cash. It's as per your convenience. Also, given the corona situation, most interaction is via electronic means. So that could also be a convenient point of contact for you as an investor. So once that is established, the broker will then purchase these stocks upon your instruction on the market. And once the shares are purchased, we have what we call a settlement cycle, which runs T+3, that is transaction plus 3 days. So if your shares trade on, say, Monday, your shares will settle on Thursday. If you are selling, for example, your payment will be due on the 3rd day of settlement. And if you are buying, basically, you will see the shares in your account. If you're selling, you will not see the shares in the account. Right. So also one of the obligations of the broker is to ensure that you receive what we call a contract note upon your settlement. So once you have traded your shares and settlement has come, you need to receive what we call a contract note from your broker, which will basically outline what stocks have traded, the trade date, settlement date, the price, and the commission breakdown, inclusive of your name. And that will serve as a legal document as proof of the transaction as well. Right. So basically that would be the process of investing, but there are other factors that would need to come in. And one of them is for you as an investor to stay abreast with what is happening in the market. Because as I stated earlier, investing in shares is a volatile activity based on the fact that share prices may rise and fall on the basis of the market being purely competitive. So having said that, as an investor, some of the obligations that you would have upon yourself that the broker is happy to help you with is that you would need to monitor your investment. So at Stockbroker Zambia, we have a mailing list in which, that we send to all of our clients or would-be clients. Everyone on the call is welcome to subscribe to this list, and you will receive daily the market price sheet that will give you an indication of what traded on the market, what shares traded, the share price movements, and also the movement of the index. So that will help you keep abreast as to what is happening on the, also help you be informed with what's happening with the companies that you are invested in. Also in our daily emails, we publish the corporate actions, or we publish any market announcements that may have come out on the day. And market announcements come directly from the issuer via the LUSE, and we will then pick it up from the LUSE, and we would then circulate to our clients. So market announcement can fall under any category, from financial results to a cautionary, to an offer for sale, a rights offer. And basically these are announcements that comes from the companies to basically keep shareholders informed as to what is happening, and that will help you with your investment decisions as well. So basically that is what I have to share today. Please feel free to get in contact with Stockbroker Zambia. We have a website at www.sbz.com.zm. You can also send us your emails with inquiries at info@sbz.com.zm. Or you can call us at +260 211 232456. I'm happy to take if there is room for that.
Yes, thank you, Maxine, for that lovely presentation.
Thank you.
I can't see any questions for Maxime at the moment, but I'd like to urge the audience that if you have any questions, you can still post them in the chat or raise your hand, and Maxime will still send to them.
Actually, I've just seen a question from Sekele Mboshi on CC Africa. The question is it a wise shares in CC Africa considering the purchase from BPI? Okay, so basically shares were purchased from BP Investments in CC Africa, and they began their purchasing in June, where they purchased about 92.7%. And so they had CC Africa had a mandatory offer recently, which was basically an extension or an offer to purchase the remaining minority shareholders' shares. And that was to give the minority shareholders an opportunity to decide whether they would like to stay in the company under a new controlling interest or whether they would like to exit. And so to the question that says, is it a wise decision? I don't think wisdom is involved. I think it's more assessing your risk as to why would you stay in the company. Now, it might be, we as stockbrokers do not advise, we are not advising clients to stay in the company. We are actually advising you to sell your shares based on, number one, the history of the CC Africa on the stock market, and also on the potential future strategy that may come as a consequence of this purchase. It is possible, it's not a statement, but it is possible, they may deregister, there may be intentions to do so. And so if you are left in this company, you will be at a disadvantage because CC Africa, first and foremost, is not registered in Zambia, it's registered in Mauritius. And so in the event, for example, if the company did deregister, you would not necessarily be protected by the regulators in Zambia, being the Securities Exchange Commission nor the LUSE. So in terms of the future of CCF Convolusa, it does look bleak. And so we are advising clients to consider strongly selling their shares. However, the mandatory offer is closed. So if you do sell your shares, you would basically put them on the market and hope that a purchase is made.
Okay, thank you for that response, Maxine. Maybe you could just type your details in the chat, Maxine, the details for contact details so that people are able to get in touch with you.
Okay, perfect. I just need to figure out how to do that.
Okay. Okay, thank you so much once again. And I must mention, we're streaming live on Facebook. Thank you for the Facebook crowd. Thank you for joining us. Our next presentation is on CISS, and I'm going to ask Cecilia Siavusu from Altus Capital Limited to make her presentation. Welcome, Cecilia.
Thank you very much, Stali. Hello, can you hear me?
Yes, we can.
Okay, thank you very much, Stali, for this opportunity. I'm Cecilia Siavusu from Altus Capital Limited. We are licensed fund managers. We're dual licensed by the Pensions and Insurance Authority and the Securities and Exchange license to conduct activities in the capital markets, whereas the Pensions and Insurance Authority, they've given us a license to offer pension fund management. So today we'll talk about unit trust investments or investments in collective investment schemes. But before I get to that, I think it's important for one to realize the importance of financial planning before you even think about investing in unit trust. So now, what is financial planning? Basically, financial planning is a process of meeting individual life goals through proper management of one's finances. A person, just like we have any other timelines, a person will have their own financial timeline. For example, from the age of 0 to 20 years, a person will be learning. They spend most of their time learning how to walk, how to talk. Priorities at this stage would just be learning to basically get a fit in life, how to get a fit in life. Between the ages of 20 and 40 years, you find that people start earning an income. Most of them will be in employment, but the priorities would differ because the priorities for a 20 to 30-year-old will be mainly focusing on themselves. They will not focus on their finances. They'll leave it for the future. And you find that when somebody hits the age of between 30 and 40, at that stage, they are getting married, they're trying to settle, children come into play, they have school expenses crippling in, and they find themselves financially stressed. And at that point, they start asking and wondering how even their salary now becomes inadequate. Then when somebody hits their ages of 50 to 60, basically at that stage, they are focusing more on retirement and having a good life in retirement if they prepared for retirement. So basically, before we actually get to 50 and 60, we need to review in our 20s. We need to have a personal review of our financial status and start planning around that. It shouldn't happen when you reach the age of 50 that you start wondering where your money is or how you spent your money in your active working life. You've been working for the last 30 years. What happened to you? So basically, that's where unit trusts come in, because at this stage, especially I'm addressing the ages of between 20 up to 50 years. This is the stage when we should be building our wealth. This is the stage when we should be looking to invest in different investment options that are out there. I think Maxine has just talked about shares, their unit trust. You can invest in a property unit trust. So at this stage, this is the stage when somebody should realize, reflect on their life to say, where am I in my life? Where am I going? Am I just spending money at the shopping mall? Am I financially stable or am I financially unstable? So basically, before you get to invest, to think about investing, you should do your own personal financial planning analysis. You assess yourself. And once you assess yourself, then you go out in the market to start looking for these products. So now, anyway, not to derail you, I'll talk about a unit trust. So a unit trust is one of the ways or options that you could use as a person to actually set aside funds to meet your future expenses or to meet expenses on a rainy day. So basically, a unit trust is a collective investment scheme which enables an investor to set aside funds on a monthly basis, on a quarterly basis, depending on affordability. It's called a collective investment scheme because we pull funds from different investors and invest it on their behalf in different money market instruments. So the minimum, for example, someone can invest in a unit trust. You can invest, there are some on the market where you can invest as little as 50 kwacha, 100 kwacha per month. But from the 50 kwacha, it will be difficult for you to actually, for example, if you want to invest in shares, it will be difficult for you, in a treasury bills. With 100 kwacha, it will be difficult for you to actually go and invest directly with Bank of Zambia. You need to use an intermediary, and that intermediary will be a company offering unit trust. So the company will pull the funds, the 100 kwachas from different investors, and at the end of the day, they will have a 30,000 kwacha or a 50,000 kwacha, which they will invest for you, say in treasury bills. And you get to have the same return on your 100 kwacha, which somebody who has invested a lump sum directly in treasury bills. So it's beneficial for you not to say, okay, I don't have a lump sum now, I'll sit until I build it up to 25,000 kwacha so that I can achieve the minimum to go directly. You can actually start investing through unit trust service providers on the market. I think on the market we're about 6-7 players, and we offer different products, but we meet the same needs. And unit trust, in terms of governance structure, they are very safe investments because there's a strong governance structure in place. And this structure has been put in place to protect public funds. So by virtue of it being a unit trust, it's managed according to the Securities Act. And there are 5 players according to the Securities Act who should manage a unit trust fund. So there's a trustee who acts in your best interest as an investor. Currently, most players on the market are using AMG Global Chartered Accountants. So the trustee will make sure that your interests as an investor are protected. There's a custodian. The custodian will actually hold the assets of the unit trust. So your money won't sit on the balance sheet of the fund manager. Your money will sit in custody safely. So for example, if a unit trust company managing your money or a fund manager managing your funds goes under, your money will be safe because it's held in a custody account. Currently, we have 2 custodians on the market. We have Standard Chartered Bank and we have Stanbic Bank nominees. So those are the companies or the banks that are offering custodial services. And they ensure that the fund managers don't actually dip their hands into clients' money. The only time fund managers will have access to clients' money is when they are collecting their monthly fees. Other than that, it's the role of the fund manager will be to make investment decisions, prudent investment decisions. The other party to a unit trust fund will be the unit trust fund should be 2 different companies. So that is meant to bring about transparency. Then the other party to a unit trust fund will be the regulator, who's the Securities and Exchange Commission. Their role is to make sure that trust funds according to the provisions of the Securities Act. And the regulator has oversight on the activities of fund managers because every month the fund manager submits a return to them, which shows how much money the fund manager has, and they will also submit a liability schedule to match the money which the fund manager has. So the liability schedule will show all the investors and their balances in the unit trust. So basically, that report is sent to the trustee, to the regulator, to make sure that when an investor comes, when an investor comes, their money should be there. Or when the fund manager God forbid, goes under, there should be sufficient money to pay off everybody in the fund. The other party, the last party to a unit trust fund is the fund manager. So basically the role of the fund manager is to grow the unit trust fund and also to make sure that they invest the money to the benefit of the unit holders. So the fund manager doesn't own the unit trust. I think there's a misconception out there when a client gives money to a fund manager, they feel like they're actually investing in the fund manager. You are not. A unit trust is a separate legal entity, which is separate from the assets of the fund manager. So the role of the fund manager is to make sure that they manage the money according to the provisions of the law. For example, if a fund manager has breached the law and they are found wanting by the regulator and they are not managing the unit trust according to the funds entrusted to them in the trust fund, according to the provisions of the law, they have actually power to actually cancel the license of that fund manager and appoint another fund manager who manage the funds in a prudent manner. So now I'll talk about the types of unit trust funds that are available on the market. There are different types of funds that are available on the market. So generally, I'll talk about the funds that are there, the common funds that are there. So typically, there will be a money market fund. So the money market fund will enable investors to invest funds in treasury bills and government bonds, as well as bank deposits. The minimum investment amount someone should have is 100 kwacha per month. There are some fund managers whose minimum investment amount is a 50 kwacha on a monthly basis. So you can imagine for a 50 kwacha on a monthly basis or 100 kwacha, you can actually build your future reserve for a rainy day. Because, for example, I'll give an example. If today I gave you 100 kwacha and tomorrow I asked you to say, can you account what you spend the 100 kwacha on? Most people will struggle. Why? Because you can spend 100, but you spend 50 kwacha on talk time. The next day you spend, or the very day actually, you pass through a mall. You just buy 2 loaves of bread and the 100 kwacha is gone. But if you are investing that 100 kwacha every month, at the end of 1 year, you have 1,200 kwacha. At the end of 2 years, you have 2,400 kwacha, plus the interest the funds will earn. You find that maybe you have 2,700 kwacha. But there are some people who actually argue, they'll say, no, I can keep that 100 kwacha to myself. After 2 years, because I've been in this industry for a long time, you call the same client, show me the 2,400 you've earned. Then they realize to say, actually, it's difficult to keep money. And at that point, they'll realize to say, okay, fine, if I'd signed up 2 years ago, I would have had a 2,400 plus interest in my account. I think I've wasted time. Let me sign up. So basically, that's that about the money market fund. The other types of funds that are available on the market, you have an equity fund. Maxine talked about shares, that you can invest in shares directly listed on the stock market, on the stock exchange. But if you are a first-time investor and you're worried to say, okay, fine, I don't really know how this goes on, you can invest your money through a fund manager in a pooled fund. So in the pooled fund, in the equity fund, the beauty about you investing in an equity fund before you actually go out to invest on your own is that the fund manager will actually monitor the equity fund for you. So the fund manager will diversify the risk. They will invest in 4 or 5 types of shares or stock that they think have got potential for growth, such that should the share price go down in one, the other 4 should be able to cushion you. Because I understand it's very discouraging for an investor. For example, you invest in one company, you put all your money, and the share price in that company goes down. You feel like, oh, you've lost out. But if you invest in an equity fund, you'll be using the expertise of the fund manager, because most fund managers have been doing this for a long time. So you'll be tapping into their expertise. Growth, which stock actually pays good dividends, and they will invest in those. And should the share price come down in one, the others should be able to cushion you, plus the dividends that you receive. The other types of funds which are typically available on the market will be a debt fund, and most fund managers will call that a high yield fund. So this is a fund which you invest, of course, it will be a mix. They'll invest in treasury bills, they'll invest in government bonds, they will invest a portion as well in microfinance deposit taking institutions. So for this one, they call it a debt fund because you're lending out the money, not really lending out in that sense, but you're investing in an institution that lends out money. The return on these funds is good, and the risk is also low to moderate. For the money market fund, the risk is actually minimal because you're investing predominantly in treasury bills. For equity fund, the risk is very high because the performance of your investment will depend on the underlying stocks or shares that the company would have invested in. The other type of fund which is available on the market will be a property fund. As we know, the property market has been booming and everyone wants to invest in the property market, but there are people who might not have a lump sum. You don't have a 500,000 to build maybe a flat that you rent out. What you can do is that you can invest through a fund manager in the property unit trust. So the property unit trust fund works in this manner. You get money, okay, or a fund manager will develop a property and then they sell it to a fund. So in the fund, people will be investing from as little as 1,000 kwacha. So for example, you get a property maybe in Roma Park. Roma Park, we know that for you to get a plot there, you need to spend like 800,000 kwacha. But if you pull money from different investors and invest it in a property in Roma Park, and rentals in Roma Park are very expensive, are very high, you find maybe somebody's spending $2,000 or $2,500. So for somebody who's invested 2 million in developing a housing unit in Roma Park, and for you who's spent maybe 10,000 kwacha, but you've invested it, you've put resources together and invested it as a group using a property fund, you'll find that you have the same rate of return because the return will depend on how much money you've put in. So those are some of the products that are there for investors to partake in the market in unit trust. How do you invest as a person? What is the process that you should take? Like I mentioned, there are several players on the market. So you can actually go to a unit trust service provider. Once you get there, they will explain how the product is structured. They will also assess your needs. They'll also assess your risk appetite. And based on that, you can actually fill in a form. You transfer money into the unit trust account, and the fund manager will invest. They open a unit trust account. Every fund manager has a system. They'll open your account in the system. And every month, we are obliged to send statements. So you start seeing how your money is growing on a monthly basis because we're obliged to send you statements as service providers on a monthly basis. Should you want to withdraw your money, the unit trust funds will have rules that govern them. It's not a bank account where today you invest money and tomorrow you just come and withdraw it. For example, money market funds, the minimum investment period will be 90 days on every deposit a client makes. The debt funds, the minimum investment or high yield fund, the minimum investment period will be 6 months. And for property fund, the minimum investment period will be 1 year. So before, when you start investing, you are not allowed to come back and withdraw the money the following day. If you do that, to meet your liquidity needs, the fund manager will charge you a penalty, and the penalties will range between 1% and up to 5% of the amount you are withdrawing. The reason they will charge a penalty is because they want you to have a disciplined approach towards your investments. So basically, that's the process of investing in unit trust. And now, I think looking at the theme for the World Investor Week, I would like to give tips to investors because we've seen quite a number of Ponzi schemes that have mushroomed on the market, and most people have invested in those because they've been promising out of this world returns. They're promising 150% return on your money. And eventually you find that the company disappears or it folds, or when you realize it's a Ponzi scheme, you lose out money as an investor. And then it just tends to demotivate you from investing in any, or even looking at other investment options on the market. But as an investor, you can actually be smart in the way you approach your investments. I'll give you tips on how to be a smart investor. The first thing you should do is that you should need to verify whether the fund manager is licensed. I think in my introductory remarks, I did talk about Altus Capital being regulated, licensed and regulated. We'll have Equity Capital Resources, we'll have Hobbiton. All of them are licensed and regulated. The reason you need to invest in an institution that is licensed and regulated is because it will protect you. Remember the governance structure I talked about, the unit trust. There are a lot of players there that have been put to make sure that your money is safeguarded. So you need to ensure that a player is licensed and regulated. You also need to conduct research on the products that you're investing. Make sure you invest in a product that is licensed. You can invest with a fund manager who's licensed, but you find that maybe their product has not been licensed by the regulator. So always ask and ensure that the product that you're investing in is licensed by the regulator, because that is very important. It will protect you as an investor. You also need to assess the fees which the investment managers are charging. Different investment or fund managers will charge different fees. So you need to investigate and choose a fee that will not, a fund manager, in addition to all these other things that you're doing in your due diligence, make sure that you look at the impact that the fee will have on your investment. You also need, for you to be a smart investor, you need to understand the risks that exist in every product or every product that you're investing in. For example, I talked about the shares. The shares are very risky, but the world over, shares have been known to outperform any other money market instrument, but you just need to be smart about it. Make a decision. How are you going to structure your portfolio if you're going directly to invest in shares? Or if you're going to invest in a unit trust, look at the track record that the fund manager has. The fund manager has to give you a track record. For example, I talked about Altus Capital starting in 2017. You can actually ask for information to say, from 2017 to date, I want to see the performance of your funds. What has been your performance year on year, so that you are able to make an informed decision. Avoid get rich quick schemes that I talked about, the Ponzi schemes. These will discourage you from building a genuine portfolio of investments to cater for your future needs, because then you'd have lost money in all these schemes. It's better you invest in an institution that is licensed and regulated. Also, you need to recognize the power of compounding interest. When you start investing early, I know there are a lot of people who say, no, me, I don't have money. I only earn 3,000 kwacha. Believe you me, money is never enough. If you put someone who's earning 3,000, the person earning 100,000 kwacha will also equally say, I'm broke. Why? Because it's about lifestyle. The person earning 100,000 kwacha, maybe their lifestyle, they'll be thinking of going on only to Dubai, doing etc. Spending. You are getting on a bus, you see someone selling bananas, you are even 100 kwacha on a monthly basis. Someone earning 100,000 kwacha, depending on how they are financially disciplined, benefit from the power of compounding interest. If you start early investing, you find that 10 years from now, your money would have grown, because the interest the money is earning will also be earning interest every year. For example, the interest that you earn today, this year, for example, you invested 1,200 and your money is at the end of the year, it's 1,500 kwacha. After 1 year, you have 1,500 plus, if you continue saving 100 kwacha, you have another 1,200. That 1,200 will be earning interest, so your money will be growing. Also, you need to recognize the importance of diversification. Don't put all your eggs in one basket. You can invest in different asset classes. You can invest in a unit trust, you can invest in shares, diversify your portfolio. I know most investors will give an excuse to say, no, me, I'm too heavily weighted in. 200 kwacha, so that your money continues gaining interest. You need to plan a end of the term. Parents are running around going to borrow money from Kalova, where they're paying 3 times interest, when they could have earned that interest if they just decided to say, okay, fine, how much 1,200 every term, every month, so that at the end of the term, I can withdraw the money and invest it. Remember, the money that you'll be putting with a fund manager, it will earn interest, as opposed to you going to borrow Kalova at 50%. So basically, anyway, that's all I had for you. I'll invite questions. I can keep talking about investments because I'm passionate about savings and investments. So for now, I'll invite questions. Thank you very much.
Okay, thank you, Cecilia, for that. We can actually see your passion for investments. And there are some questions for you in the chat. Kalukango would like you to go over the debt fund. You had mentioned the debt fund. Just go through that again. I think concerning the debt fund.
Fund. Okay, I use the generic name. We'll call it a high yield fund. For example, at Altus Capital, we call it a private wealth fund. Check, I think even Longhorn, they have a similar type of fund. So basically, I'll talk about the private wealth fund, because if I talk about debt fund, I think I'll create confusion. So a private wealth fund, basically, it's a unit trust type of fund which invests in different money market instruments. So it invests in treasury bills, it invests in government bonds, and to a certain extent, we invest up to 15% of that fund in microfinance institutions, deposited in a deposit taking like microfinance institutions. The microfinance institution will lend the money to a third party, and the interest they'll charge on that money is what they'll credit back on our investment. So for example, we invest at 15% with a microfinance institution. Sorry, we invest at 20% or 25% with a microfinance institution, which will lend the money at 30, 40%. So when the money matures, they'll give it back to us at 25%. And as an investor, you get to benefit from that, because all the interest that we'll get from that investment will accrue to your account. So basically, that's that about the debt fund. Otherwise, except the instruments there. Microfinance institutions. And in doing that, before we invest in microfinance institutions, we actually do a due diligence. We'll not just give money because it's a microfinance institution. No, we actually have a team of investment analysts in the office who analyze, who look at the financials of a microfinance institution. We'll also go further to look at their portion of restructured loans, because if a microfinance institution has a lot of restructured loans, it means people are borrowing money from that institution. The institution they will roll over that there is that risk. We will not invest with that institution. We'll also, are they depending on government business? Like, are they lending out to government institutions? Deducting from civil servants, and they're not remitting to banks or microfinance institutions. So that has put pressure on these institutions. So for us, we'll look at the structure of their loan book. Is it heavily weighted to government institutions? If it is, so basically, those are some of the things that we look at before we invest money. It's a high yield fund because you are taking on an additional risk. For example, the private wealth fund here at Altus is earning about 20% per month because of that additional risk. The low risk fund, the money market fund, is giving a yield of about between 15 and 16% per year. So I hope I've answered that question from Kalua.
Okay. And I think you also covered Dingiswayo's question on returns and interest rate on investments for the unit funds. There's a question here where they're asking us whether we have a list of funds that can be used when someone wants to research on the type of products that are in the market. As a SEC, on our website, you will find a list of dealers who we license. So those are inclusive of fund managers as well as brokers that one can contact to make different types of investments. Okay, thank you for that, Cecilia, once again. And I'd encourage the audience to keep the questions coming. We're now going to have a presentation from presented by Tidale. Tida, are you with us? Tida? Okay, I think she's not yet with us. While she's preparing, maybe we can just also go through what this week is about, or rather this month is about. Like I mentioned earlier, it's World Investor Week, and we are commemorating World Investor Week for the rest of the month of October, just creating awareness on how to be a smart investor. I'll ask Dingase just to shed more light on that and also share the activities that we have lined up for the rest of the month.
Thank you, Charlie. I'm not sure whether Cecilia answered the first question I'm seeing about the minimum period to invest in a debt fund.
Oh, okay.
And there's also a follow-up to that, the minimum amount and also the minimum period to invest in a debt fund. I suppose this is a period.
I've actually seen the question. I had to copy the question. Yeah, so the minimum investment amount one should have in the debt fund is 1,000 kwacha. And the minimum investment period is 182 days, which is 6 months. So within that period, if you invest that amount, you are not allowed to come back and withdraw the money as an investor. Thank you, Dingase.
Okay, thank you, Cecilia. Let me just share my screen quickly as we wait for Tidale.
Okay, so Dingase, as you are trying to share your screen, not to discourage people that might have an amount less than 1,000 kwacha, we do have products, the minimum investment amount is 100 kwacha. Yeah, so over to you, Dingase.
Okay, that's really nice to hear and very encouraging to some of us who might be thinking this is just, it does look like it's a very affordable product to be in for our savings. So my name is Dingase, Dingase Nunkwemakumba. I'm just going to go through what the World Investor Week is all about, and very quickly, as I'm aware that this time slot was actually meant for Tidale, who's going to be talking about some other very important things as well. So just to bring us to speed, just a minute. I do know that it can be very rude if you can't see me. It can look like I'm avoiding you. So we're going to look at the background to the World Investor Week. As you know, this whole virtual exhibition program has been brought about as part of the events during the World Investor Week, which we are commemorating this week. So I'll talk about its background. I'll then talk about the objectives. And I'll talk about the target groups and its timing, which we have been talking about, and some proposed programs, and resonate with what the presenters have been talking about this far. So what is the World Investor Week? It's It's a campaign actually that has been brought about by a world organization called the IOSCO. The IOSCO is the International Organization for Securities Commissions for securities regulators and participants. The Securities and Exchange Commission is a member to IOSCO, and so we are responsible. And part of it is to foster investor education in a uniform manner around the world so that investors, even as they cross borders, they will be able to participate in the offers in the financial markets, especially the securities industries. Find anything that is varying too much that they get lost anywhere in the world. There are many other benefits that the IOSCO offers, and some of them are meant, almost all of them are meant to protect investor interest. And what has been discussed is like encouraging different kinds of offers from all manner of providers, some of them which are not well-meaning. In other words, some of them might meet fraudsters or scammers. So the World Investor Week is really meant to help investors for themselves knowledge that can give them capacity to make well-informed investment decisions. So it is to disseminate those messages that further investor education and protection, as well as financial literacy, and then also foster we are just doing right now. And I do hope that everyone has learned quite a bit, as I have from the previous presenters. The target groups, we have the primary target groups as the children, and this is also part of the same in our national financial education policies in the country. We are really focusing on the children, as the saying goes, catch them young. So we are conducting awareness programs that are going to help the children know about the opportunities that are embedded in the financial sectors now, so that at the time they start earning and needing to make those proper financial decisions, they already know how to go about it and where to go. We have the youths as the next most important group because we know that the youth are just starting up, and we need them to plan for their future financial well-being. What is learned at a tender age is really something that is inculcated in one's behavioral patterns. So that is why we target the children and the youth. And we also have cross-cutting investor educational programs. The adults are not left behind. Most adults right now are asking themselves about their time in there as they go into pension. How are they going to live? How are they going to afford the various things that they are used to, whether in employment or when they have the energy to make money? What will happen in the time when they do not have that? So we also have programs that help them in that, to make decisions to prepare themselves for pension life. The theme, I'll go straight to the theme for this year. It has evolved a little, just for the fourth time. It's an annual event. The first time we commemorated it was in 2017. Was in 2017 under a smart investor as the theme. Has gone to grow, saying a smart investor through be a smart investor through capital markets, because this is to encourage you to really own the theme and become a smart investor through the various behavioral aspects that have been discussed already. So the World Investor Week is an annual program and usually is intensified during the first week of October, which is what we're doing right now, today being the last day. But however, the good news is that it continues through to November and generally through to the year, because education, as we all know, does not end. We continue learning. So even as we interact with our fund managers and other, that this is just to initiate you, and that you'll be making actions towards going to visit their offices and get the investment advice that you need, and also start investing. Maybe you already know, but at least now you may find yourself asking different sets of questions. The activities are various. They are educational in nature. We undertake a launch, ministerial launch. We also undertake familiarization tours for schools. They have in the syllabus market items now have been embedded in the syllabus, and so we welcome schools who wish to have a practical knowledge about what they are learning to come to our offices, where we do familiarization for them, familiarization tours for them. Basically exhibitions, and because of COVID-19, this is the one that is going on right now, and many others. I'm aware that Tidale is ready for us, so I will not take too much of your time anymore. Just to mention that even as we influence the syllabus, we also bring to speed the teachers or the educators. So we did have an educational symposium, I think in the previous year. One of the previous years we were commemorating, where after actually updating the syllabus, we are cognizant of the fact that they also need to understand things the way we understand them and the way that they are evolving in the market. So we did bring all the business teachers into one place. Luckily that time there was no COVID, so we could do that, and just went through what we have actually put in the syllabus, so that they can go and teach the items, the knowledge correctly. This is just for everyone to appreciate our efforts, and those are media programs. And this year we have been doing similar educational programs, and those are the ones that are lined up there. I think I'll leave it here and invite Tidale. The investment basics, Cecilia has gone through them. I'll just pause a little bit. But otherwise, Tidale, you are welcome now. I'll end my presentation there. We will share to those who would like to.
Thank you, Lingase.
Let me just mention that if you wish for us to send you these presentations, please put down your email addresses in the chat. Thank you so much, Stali, and over to Tidale.
Okay, thank you. Welcome, Tidale. Tidale is representing the Capital Market Association of Zambia. You can go ahead.
Thank you very much. Yes, please. Really, to be honest, it will be an echo of everything we've heard today. It's just a word of encouragement to everybody about how you need to invest. The first thing you need to do is make that decision to be investing in the first place. Decide to be an investor, decide to invest. That is very important. It secures your future, it secures you. So this is it's a bit theoretical, but it is also very practical that you know why you are doing something. Why are you investing? Are you investing for long term? Are you investing for short term? Are you just speculating? Is it just something you're trying to do? Okay. Once you know your objectives, then you know what exactly you're going to invest in. Those are basic steps that you need to go through, and you need to understand why you are doing that. So are you investing for long term? Are you investing for short term? Are you being a speculator? Then you are going to know who you are going to see. If you are going to be a long-term investor, a speculative investor, go and see a stockbroker. Go and see Cecilia, and then she's going to tell you which money markets you are going to go into and put your treasury bills and get money into after 60 days and that kind of thing. Those are important things you need to know. If you are not understanding why you're making an investment in the first place, you find yourself being a bit disappointed, a bit shortchanged. A practical example is people who come to buy shares, and then after they earn a dividend, they are given a dividend, they say, I've been seated with this number of shares for 2 years, and then I've been given a dividend of 10 kwacha. Were you understanding why you were buying shares in the first place? Were you buying the shares for dividends? Were you buying the shares as a long-term investment? If you were buying for dividends and the returns that dividends give, did you invest enough to begin with to get that return that you were expecting? So it's very important that you skew your mind as to what it is you are going to get into. Without that understanding, it's very difficult to appreciate the returns that you are going to gain from the investment you make. Also, it's important to know your risks. How risky is the investment you are going into? Is it high risk? Are you a high risk person? How much money are you willing to sacrifice? For how long are you willing to sacrifice that money? So all those thoughts that need to go through your mind before you are deciding what investment you are going into. These are some of the discussions that we have at Pangea with the clients that come in to help them understand what it is they are trying to get into before they decide what investment they are going to make. There's also the issue of diversification that comes into play. There's the issue of don't put all your eggs in one basket. True, but how are you diversifying? Are you diversifying in one sector or one form of investment, speak to your investment advisor and let them elaborate clearly what that diversification means. For the investor out there, my word of advice is understand clearly what it is you're trying to do. That the only way you are going to meet your objectives. Is also the issue of, as investors, we are always thinking you put money today, and that's a common question comes into the office. So if I give you my 1,000 today, how much will I make after 3 months? It's not like that. It's not a get rich thing kind of arrangement. And hence people are always getting into situations where they are big, where fraud comes in, where they're being duped out of money. If it is that easy to get rich, everybody would be rich. Be very careful. There's a lot of fraudulent schemes out there. It is not every day that you can just march into something, invest something, and then after 2 months, then you make so much. Whether it is in shares, it's in bonds, it's in investment schemes, it is not that easy. You need to be aware, you need to be diligent, fly around like that. Be very aware of fraudulent schemes. Go to licensed people. Get your money invested in a correct way, and always, as much as possible, do not invest money in a venture that you will need tomorrow. Investing and spending are a bit different. So if you have a bill to pay tomorrow, save that money and pay that bill. Put that money in investment and hoping that tomorrow when the bill needs to be paid, that money would have doubled or tripled or whatever it is, or would have gained some form of interest. There's a very big difference between spending and investing. So I don't know, any other questions, Dikasi?
Thank you, Tidale. Those are very, very useful remarks. Very important to everyone. I like the one where you say if you need the money immediately, don't invest it. That's very, very good. And it helps to reduce frustrations with investments, because sometimes you become impatient or you need that money. And Cecilia did allude to the fact that you will be surcharged when you want to withdraw before the time that has been given to you. So you might just find that your money reduces and you get very frustrated.
Yes, and then it discourages the next person, right? You start thinking, oh, I shouldn't be investing in the first place, and yet it is a question of just not following that there's consequences to planning. So you need to plan. Investment is an important thing, yes, but also plan.
Yeah, also plan. Know your objectives for investments. With that, we've gone quite a bit over the time promised. We have our charts were supposed to, oh no, we're still within time. So I'll let Stali take over and maybe just go through any other questions that we have. And we welcome the audience, obviously, to raise your hand and contribute, clarify, or ask. This is an opportunity we have facilitated to talk to your investment advisors, basically for free, actually. So, and sometimes we may have already invested with these people or still contemplating investing. Ask the questions. I'm sure they are very ready to answer. Thank you.
Okay, thank you, Tingasa. As Tingasa has highlighted, please go ahead and ask your questions or comments. We've taken note of your comments in the chat. Where thank you for the presentations, and we are glad that we're making an impact, and you can see our efforts, and we hope this can make a difference. We do have some questions from our Facebook audience. We have the Mulubi who's asking what steps are being taken by the capital markets in order to just shed more light on capital markets and investments. Maybe I can start with that actually. So one of the steps that we are taking as a commission is to do awareness campaigns, one of which is the World Investor Week, which we have now. We also have other campaigns running, such as the joint messaging campaign, where we've partnered with regulators, with other regulators in the financial sector, that being the PIA and BOS. And we're also running an awareness campaign in that space for the next 12 months. So you will see a lot of us out there trying to just educate people, because we have noticed there's a lot of misinformation and people are ending up being defrauded of their hard-earned money. Any additions or comments from Tida, Tingase, and Cecilia?
Well, I think the addition to that is just the timing. The financial sector joint messaging campaign, actually the correct way is financial sector regulators joint messaging campaign. So the regulators have come together, the Bank of Zambia, the PIA, and the Securities and Exchange Commission, to foster financial education and also just bring a little bit more light to what is going on, to let you know that investment is fraud is real and it's out there. We receive complaints, and sometimes we just observe through our surveillance systems. We have seen that there's a mushrooming of financial products that are of fraudulent nature. And it is very sad to know that there are formal financial service providers who we are regulating and making sure that we are protecting investors from being defrauded or from losing money. And yet people are still going into such products which are overpromising and just a way to lose their money. So we have brought about, we have availed ourselves, and every Tuesday at 15 hours, there's a chat room, which we would like you to be joining just to hear more. We don't overcrowd it with topics, so we pick different topics each time so that we can discuss it extensively, so that you can know for yourselves how to identify a thing such as a pyramid scheme, which is illegal. All pyramid schemes are illegal. Well, but how do you know that this is actually a pyramid scheme? You may not know right away. You just think that I'm going to put my money and I've been promised that I'll get out this amount and so on. So we want to help you identify the illegal schemes and be very careful with how you invest in such things. If you should feel like going ahead, then you know that you're taking the risk on your own, and that you might probably not even have a redressal system when you are investing with an entity which is not licensed by any regulator. So please do join us every Tuesdays at 15 hours. There will be a lot more shared. This exhibition will end, unfortunately, today, but we still have other platforms where we are actually talking about similar issues. Thank you.
Okay, so we can continue the discussion on Facebook. We are streaming live, so we can still send your comments and questions to the Facebook chat. And then also we have a question from David, Colonel David. He mentions that he joined late. He wants us to explain government bonds and how treasury gains work. We did have a presentation yesterday from one of our market players where they were speaking to us about how to trade secondary trading of government bonds. So maybe I'll urge you, Colonel, to just drop your email address in the chat and we can share that presentation with you. Okay, thank you so much. If we don't have any other comments or questions, I'd like just to thank the audience for joining us and thank the presenters for the insightful presentations that we've had today. And we hope to see you next week. You can join the chat, as Dingase has mentioned, so that we can continue just getting knowledge on how to be aware of the products that we have in the market, and also how to be aware to just protect yourself from being defrauded. Before I end, I will just go through some of the key takeaways that we've had for today. So from Maxime's presentation, she highlighted how to open an account with a broker. She highlighted the forms that you fill in, and also she urged you to pick companies that are based on the type of investment that you like and the type of objective. And this is something that Tida has also mentioned. And then the broker will purchase the stocks on your behalf and write you a contract note upon settlement on the stocks that you bought. Cecilia also mentioned the type of funds that are there in the CIS space. We have the money market, equity, debt, and property. And then she also gave us some tips on how to invest. You go to a unit trust service provider who access your needs and also your risk, who access your needs and your risk appetite. You then fill in a form and open an account. And then every month, the statement will be sent to you. And then we've also gone through some tips on how to be a smart investor, one of which is to verify if the fund manager or the broker or the service provider that you are dealing with is licensed. That is key, and that should always be your first step. And then also, you also look at the track record of the service provider. Also avoid get-rich schemes, and also recognize the power of compound interest. And then also she mentioned that you do not put your eggs in one basket, meaning just diversify. Place your investments in different vehicles as much as you can. I would also like to just finally thank the organizers of the chat that we have today. That is the Securities and Exchange Commission and CIMAS, Capital Markets Authority of Zambia, for organizing this and putting this for the public just to learn about World Investor Week. Thank you so much. We'll see you next week during our chat room. Thank you.
Thank you.
Thank you very much. Thank you.
Thank you. Bye-bye.